Have you ever wondered why banks seem so keen to keep certain financial information hidden from you? The truth is, there are many money secrets that banks don't want you to know. In this video, I'm going to reveal 10 truths about money that banks prefer you not to know. These truths can change the way you handle your finances and help you make more informed decisions. Stay until the end to find out how you can protect your money and make it grow without relying so much on banks. Let's go. Truth 1. Banks make money from your deposits. When you deposit money in a bank, you might think it simply stays there until you need it. But the reality is quite different. Banks use your deposits to make money in various ways. They lend that money to other people and businesses, charging higher interest rates than they pay you. General summary: banks operate on a fractional reserve model, which means they keep only a small fraction of deposits on hand and lend out the rest. For example, if you deposit $1,000, the bank might keep only $100 and lend out $900. This loan generates interest that the bank charges the borrower, and this difference is a significant source of profit for the bank. Advantages for banks. 1. Interest profits. Banks make money from the difference between the interest they pay depositors, usually low, and the interest they charge borrowers, usually high. 2. Fees and commissions. Besides interest, banks also make money by charging service fees, commissions, and other charges associated with loans. How this harms you. Banks prefer you not to know how much they profit from your deposits because it might encourage you to seek alternatives that offer better returns, such as investments in stocks, index funds, or real estate. Truth 2. Savings accounts. Pay low interest rates. A savings account seems like a safe place to keep your money, but banks typically pay very low interest rates on these deposits. This means your money is losing value over time due to inflation. General summary: the average interest rate on traditional savings accounts is often less than 1% per year, while average annual inflation is about 2 to 3%. This means that, although you are earning some interest, your money's purchasing power is decreasing. Advantages for banks. 1. Low cost of funds. Keeping savings account interest rates low allows banks to access funds at a very low cost, which they can then lend out at higher rates. 2. Consumer inertia. Many consumers keep their money in savings accounts out of convenience or lack of knowledge about better alternatives. How this harms you. Banks don't want you to know that there are better options for your money, such as high-yield savings accounts, treasury bonds, or low-risk investments that can offer significantly higher returns. Truth 3. Credit card rates are astronomical. Credit cards are convenient, but they come with extremely high interest rates. Banks make a fortune from the interest charged on credit card balances, especially from those who cannot pay the full balance each month. General summary: annual percentage rates, APRs, on credit cards can range from 15% to over 30%. If you carry a balance of $1,000 and only make the minimum payment each month, it can take years to pay off the debt, and you might end up paying much more in interest than the original balance. Advantages for banks. 1. High interest profits. High interest rates mean banks make a lot of money from credit card balances. 2. Fees and penalties. Besides interest, banks also charge various fees, such as late fees, foreign transaction fees, and annual fees. How this harms you. Banks don't want you to know how to avoid these fees, such as by paying the full balance each month or opting for credit cards with lower interest rates. Knowledge about alternatives like balance transfers or personal loans with lower interest rates can save you a lot of money. Truth 4. Personal loans have hidden fees. When you take out a personal loan, there can be many hidden fees that increase the total cost of the loan. Banks might charge origination fees, processing fees, and other charges that are not immediately apparent. General summary: a personal loan might seem like a good way to consolidate debt or finance large expenses, but it's important to read the fine print. Origination fees, which are a percentage of the loan amount, can be significant. Additionally, banks might charge fees for late payments, early repayments, and other services. Advantages for banks. 1. Additional revenue. Hidden fees increase the amount of money banks make from each loan. 2. Complexity. The complexity of loan contracts can make consumers unaware of the true cost of the loan until it's too late. How this harms you. Banks prefer you not to be fully aware of these fees so they can maximize their profits. It's important to compare different loan options, read all terms and conditions, and ask about any fees before signing a contract. Truth 5. Investment accounts can have high management fees. Investing through a bank might seem convenient, but many banks charge high management fees on their investment accounts. These fees can significantly erode your returns over time. General summary. Management fees on investment accounts can range from 1% to 2% or more of the portfolio value. While this might not seem like much, over years or decades, these fees can add up to a significant amount of money that could have been working for you. Advantages for banks. 1. Recurring income. Management fees provide a constant source of income for banks, regardless of the investment performance. 2. Additional services. Banks often charge for additional services, such as financial advisory, which can further increase costs. How this harms you. Banks don't want you to know there are low-cost alternatives like index funds and ETFs that have much lower management fees. Investing through discount brokerage platforms or robo-advisors can also be a more economical option. However, have you ever thought about earning between $5,000 and $10,000 per month as extra income by creating simple videos for YouTube like this one? I have a complete and straightforward course that I developed for a single payment of $29.90. The link is in the first pinned comment of the video and in the About section of the channel, okay? If you're interested, just click the link to know more. But now, back to the content. Truth 6. Bank marketing encourages overconsumption. Banks often encourage overconsumption through marketing and credit card reward programs. While these programs may seem like a way to earn benefits, they can lead to unnecessary spending and debt. General summary. Credit card reward programs offer points, miles, or cashback for every dollar spent. However, these programs are designed to encourage spending, and often the interest charged on unpaid balances can outweigh the benefits of the rewards. Advantages for banks. 1. Increased spending. Reward programs incentivize consumers to spend more than they normally would. 2. Interest and fees. More spending can lead to higher credit card balances, resulting in more interest and fees for banks. How this harms you. Banks prefer you to focus on the short-term benefits of rewards rather than the long-term financial impact of debt. Keeping strict control of your spending and paying off your credit card balance in full each month can help you avoid this trap. Truth 7. Banks rely on financial illiteracy. Banks often benefit from the public's lack of financial education. Many consumers do not fully understand how financial products work, which can lead to harmful financial decisions. General summary. Financial education is crucial for making informed decisions about managing your money. However, many educational systems do not provide adequate training in personal finance, leaving consumers vulnerable to predatory banking practices. Advantages for banks are 1. Product complexity. Complex financial products can be hard to understand, allowing banks to include fees and unfavorable terms. 2. Overconfidence. Lack of financial knowledge can lead consumers to blindly trust the advice of banks, even when it's not in their best interest. How this harms you. Banks prefer you remain uninformed about your finances so they can sell expensive financial products and charge excessive fees. Investing in your financial education through books, courses, and online resources can empower you to make better financial decisions and avoid banking traps. Truth 8. Banks maintain control. Through fee charges, banks charge a variety of fees, from account maintenance fees to ATM withdrawal fees. These fees may seem small individually, but they add up and can significantly erode your funds over time. General summary. Many consumers don't realize how much money they lose in bank fees. Maintenance fees, out-of-network ATM fees, overdraft fees, and transfer fees are just a few common charges that can affect your balance. Advantages for banks. 1. Additional revenue. Stream. Bank fees are a consistent source of additional revenue. 2. Disincentive to switch. Fees can discourage consumers from switching banks, keeping them tied to expensive accounts. How this harms you. Banks don't want you to know there are alternatives like online banks that charge fewer or no fees. Comparing different accounts and banks can help you find more economical options and minimize the impact of fees on your finances. Truth 9. Alternative investments can offer better returns. Banks prefer you to invest through their own products, which often have high fees and relatively low returns. However, there are many alternative investments that can offer better returns with lower costs. General summary: banks offer investment products like mutual funds, which can have high management fees. Instead, investing in index funds, ETFs, real estate, or even starting your own business can provide higher returns. Advantages for banks. 1. Investment control. Keeping investments within their own products allows banks to maintain control and continue earning management fees. 2. Less competition. Banks face less competition when consumers don't explore alternative investment options. How this harms you. Banks prefer you not explore other investment options so they can continue to earn high fees. Doing your own research and considering alternatives like low-cost ETFs or real estate investments can significantly increase your returns. Truth 10. Online banks and fintechs offer better services. Traditional banks face increasing competition from online banks and fintechs that offer better services and lower fees. However, traditional banks often do not inform their customers about these options. General summary: online banks and fintechs often offer savings accounts with higher interest rates, lower maintenance fees, and more innovative services. Additionally, they can provide better financial management tools through mobile apps. Advantages for banks. 1. Loyal customers. Keeping customers on their traditional platforms means banks can continue charging higher fees and offering lower returns. 2. Less pressure to innovate. Without competition, traditional banks can avoid modernizing their services. How this harms you. Banks prefer you not explore online banks or fintechs that can offer better services and lower fees. Transitioning to these platforms can significantly improve your banking experience and save money. These 10 money truths that banks don't want you to know can completely change the way you manage your finances. From understanding how banks make money from your deposits to exploring alternative investments, this information is essential for protecting and growing your wealth. Do your research, educate yourself financially, and take control of your finances. Leave your comment below, like the video, and subscribe to the channel for more amazing tips on personal finance and investments. See you next time.